Welcome everyone to the Railroad Retirement Board. My name is John McNamara with Highball Advisors, and in this episode we're going to talk about tax efficient distribution of your retirement accounts. Exciting stuff. Put a pot of coffee on and we'll get to it. So I just want you, the purpose of this is just conceptually talk about some ideas. This isn't really tax advice, but I want you just to think about these things because it's a great opportunity and it's really unique to railroaders. That's what I like to stress about this is, once again, the power, I talk about it all the time, the power of that railroad retirement annuity. It gives you certain advantages. I talked about in my previous video about your risk profiles because of your railroad retirement annuity. Now I'm going to talk about the tax advantages or the opportunities, I should say, that it gives railroaders. So typical assets, railroad retirement assets that you'll have, you have a 401k, tax-deferred 401k. Some people will also have other taxable accounts at time of retirement, like a Charles Schwab account or a TD Ameritrade account, something like that. Maybe you have some stocks or bonds in there or something, inherited some money. And then also you have your railroad retirement annuity that you've been paying into your whole career. And that gives you that floor of railroad retirement income, which is fantastic. And then other individuals, I didn't list it here, will have a pension, some defined pensions. So that more of that floor, that's very great for retirement. So that gives you even more opportunities to do stuff with your tax deferred accounts. And then when you have those assets and it comes to retirement, hey, I've got to fund my retirement. Obviously, the railroad retirement annuity will support a lot of your retirement, hopefully, depending upon how much you're looking to spend in retirement per month. But the average couple is annuity pays out over $5,000 a month. So that's a good floor for individuals, unless you're like in Manhattan or something. And then you have your distribution strategies. You can pro rata strategy just means that you're spending all your accounts down equally to fund your retirement lifestyle. And then you also have a sequential strategy, which means that you're spending down your taxable accounts first, right? You want to pay your taxes first, and you let your tax deferred accounts grow. Right, so that's the sequential strategy. So once again, I talk about the 60 and 30 of the railroad retirement. So I did an example here because I didn't want to get too deep in the weeds, but I kind of like to teach through examples also. I mean, I know myself, I learn a lot through examples. So I take like a 49-year-old couple, right? In this case, let's say he's working in the railroad, he's 49, the wife, she's working also, and they happen to be the same age, 49 years old. And they're looking to retire at 60. He'll have his 30 years, it'll be done, 60 and 30. He wants to do other things, so he's going to retire. They have a combined income. They do well, $175,000 a year. Great for them. Yeah, they have a taxable account of $50,000, maybe some money from a will or some inheritance. And they have a 401k combo of $450,000 in a tax-deferred 401k. And, it's growing. It's being matched by the companies that they work for. So, by the time at 60, they can expect that to significantly grow. That's another 11 years that they'll be looking to grow that money. So they'll be looking forward to their retirement. So let's just kind of look at a chart here that I put together. It's not pretty, but bear with me. So we have their incomes here, right? Income 100,000, 200,000, 300,000 on the y-axis. X-axis is their age from 50 out to 90. Most financial planners do planning out to 90. We have the tax rates, current tax rates, 10%, 12%, 22%. These are the current tax rates. People don't know, but the current tax rates, I think they're only good till 2024, 2026. Then they sunset. So I don't think they're going down again. So we'll just kind of work with these numbers. But this just gives you another reason to kind of think about the strategy that I'm about to outlay, because I think they're probably going to be going up, but I'm not a politician, thankfully. So here's the couple's income, right? They're just right at the 22% tax line. It's obviously a blended rate. They don't pay 22%. And, they're growing here. They'll keep raising their salary as they approach retirement. And then, boom, drop straight down, right? They both retired, and that's the floor now, which is the railroad retirement annuity, okay? So they've even dropped them below even the 12% line. Now what they have is an opportunity, okay? They've just retired. They really have a great opportunity, because if they don't do anything from at 70, look how their income shoots back up. And why is that? Is because the required minimum distributions come in. They have to start paying taxes on their tax-deferred 401ks. So we'll shoot the income back up. They got to start paying taxes. We don't even know if this tax rate's going to stay the same. So we want to start to say, hey, I don't want to be paying all these taxes in retirement. While I have a great floor of income, I still like to always minimize taxes, right? So I'm all about maximizing your railroad retirement. So this is what we want to talk about. So I have this opportunity from 60 to 70. I'm going to start to look to fill, if you can see, this is like a bucket, and I want to start filling it up. And what do I mean by that? Is every year I want to start looking at doing a annual Roth conversion. So I want to take money out of here. I'll pay the income tax on it. I will take that money, and then I will move it into a Roth IRA. And what does that mean? That means that all that money now that comes out of the Roth IRA as it grows, everything is tax-free. So this right here, during these 10 years, I'm going to fill up this bucket up to the 12%, knock this down, right? So now I don't have to pay the taxes as much in retirement because it's not as much. It's been converted. I've been paying taxes all along here. But the advantage of that scenario is that as the Roth 401k grows, it's all tax-free, right? So you have a great floor of your railroad retirement, which is constantly flowing, and you're now converting everything into a retirement strategy. So by doing that, this can save you hundreds of thousands of dollars. I ran this scenario just for this fictitious couple on my tax software. All right, and this would save the couple by the age of 90, obviously, and God willing, hopefully everybody makes it to 90. But by doing those Roth conversions that I've talked about every year, right, sequentially doing that, and still doing, versus a pro rata distribution, which is the red line, which has nothing to do. That's well over $500,000 in savings. Okay, so there's hundreds of thousands of dollars available to individuals by taking certain strategies to minimize taxes. To me, that's the biggest risk in retirement, right? It's taxes. We don't know where taxes are going to be going, and the sooner we can minimize our taxes, we have a better chance to keep growing our money. So conceptually, this is just what I wanted to talk to you about, give you some ideas, start thinking about it. Look at Roth conversions. I think they're very important. If you need some help, I'd love for you to reach out to me. I do some free consultations. We can talk about this strategy a little bit more if you want to pursue it. Also, I really would appreciate if you could subscribe to my YouTube channel. I'd like to get a few more subscribers in there. It's much appreciated. In the meantime, stay safe, stay on track, and until next time, take care. So long, everyone. Bye.